we met some companies here yesterday as part of Maker Village, etc. And this morning as well, we saw some companies part of the jury discussion. So liked some pitches and very encouraging to see the kind of products and solutions that people are building. So good to see all of you.
Thanks, Dinesh. Bala. So a quick introduction, Bala. Bala is with Techstars. I took over the role from him at the Microsoft Accelerator. He now has a very exciting role at Techstars. And how many of you know what Techstars does? Okay, so I think all of you will want to know Bala for sure, and he'll tell you why.
Hey guys, thank you very much for that hands up. So hopefully planning to see more hands up next time. But Techstars, for the people who don't know, is world's largest accelerator platform. We run 57 accelerators across the world. And primarily, it's an investment-led accelerator, which means we put in money, early stage funding, and then help you grow, get access to next stage of funding, get access to market, mentorship, and all of that. So that's what we do. We run across about 25, 30 industries and work with about 300 plus corporates across the world to help entrepreneurs. So our vision, if you go to techstars.com, you will see this, is to make the entrepreneurs successful. That's exactly what we do. We run one program in Bangalore. That's when I started it about 1.5 years ago. And so the first batch is out. The second batch is right now going on. We take 10 startups into a program and help, but any startup can apply to any program across the world for Techstars. So it's your choice with respect to which program is suitable for you, and then you can apply and then get in. Yeah.
So if you could just elaborate, Bala, on what the Techstar accelerator, not just the fact that you can apply to any location, right? There are some certain benefits of the program which are very unique from others. So if you could let them know.
Sure. So the benefits across any of these programs is very standard. There is an investment, which is $120,000 investment, and then there is mentorship access. We have 10,000 mentors across the world. 2,000 companies have gone through Techstars program. There are many companies which has also gone public, and so all of those guys are mentors. So you get access to really good set of mentors, which is a global set of 10,000 mentors, and then you also get access to a lot of founders who are there in about 25 plus countries. So as you're growing global, and any country, you pick any kind of market, there is someone who actually responds to you and helps you set up that. And the program itself is a 3-month residential program. So if you pick any program, like for example, if you come to a Bangalore program, you have to be there in Bangalore for 3 months. You are among a cohort of 10 other companies, and literally it's a very intense 3-month. Mostly from the survey that we kind of do at the end of the program across the world, most startups tell us that they got in that 3 months what they would have otherwise done in 2 years. So it's very compressed, very accelerated program that also helps you. We also run global events to connect to customers. What we call as a FounderCon, which happens in the US, which happens in US, Europe, and Asia, where you get to meet at least about 400, 500 large multinational companies across the table, and you can strike deals there. We also do investor days, where you are also connected to next stage of investors who actually come in and then talk to you as well. So that's the power of the platform there.
Thanks, Bala. Satish?
And Latika was a mentor. She introduced one of these startups there in the last program.
That's right. That's Nira Finance. So, Satish?
Hi. So I'm a entrepreneur in my previous life. I did semiconductor and networking companies, and one fine day I woke up and decided to turn evil, and that's how I became an investor. We are a early stage deep tech fund, very similar to my neighbor here. This is our second fund. We've done investments in about 24, 25 companies, and hopefully early next year we're going to have our first unicorn in the deep tech space. largely operate in the pre-series area. The first check is anywhere between $500,000 to $1 million. We look for some customer traction or engagement, revenue, whatever you can call that. We don't invest in idea stage, and anti-portfolio is consumer. And anybody who fits these, I'll be very happy to have a conversation later on during the day.
Thanks. Rajesh, if you could, a couple of things. Let me introduce Rajesh, and then I do want to ask him a few questions about the startups he saw yesterday and today. So Rajesh Dembler was one of the founding team of Just Dial. Just Dial, IPO'd at and valued at about $2 billion, and since then he has invested in close to about 35 plus companies, and he has a very unique way of investing in companies. So two questions, Rajesh. What is it that you look for when you're investing? And B, what is your feedback on the startups that you have seen so far in Kerala?
Thanks. Thank you, Latika. When I look at investing in a company, I just look for two things. I look for passion in the entrepreneur. I look at the entrepreneur more than the idea itself. And how well the entrepreneur knows the industry and how passionate he is about it. And that's the basis, because the rest of it is all about execution, right? So if I recall over the last 5 years, there are 3 companies that I'm involved with that are now listed on the stock exchanges. 2 in Mumbai, 1 in New York. We are in the midst of maybe listing another one in the next 4 or 5 months in Sweden. So it's been a pretty decent run in the last 4 or 5 years, just because of that fact that you look at the entrepreneur, and that's worked for me. I have been domain agnostic so far. I have done food, I have done technology, liquor, and fashion, and yes, so on and so forth. Thanks, Bala. So I'm doing, I met another very interesting startup in Jaipur the last time we did Highway to 100 Unicorns, and I was thanks for that invitation. I think I met a great founder there, and I think he was so passionate about what he's doing. So he was doing a pre-series A, and the existing investor was, again participating. So I said I'll match it as well, because I like that guy's passion with what he's doing. He's already gone into 5,000 pin codes in India and so forth. So I look for those kind of. So in short, I look for entrepreneurs who are not looking for funding alone, are willing to build businesses, and who are willing to not focus on valuations, because valuations will come automatically. I look for founders who are willing to work towards revenue. If I can see a business with $1 billion of revenue, a unicorn in terms of revenue, that is going to be a dream come true more than anything else. So that's what I do. Yeah.
Thanks, Rajesh.
Thanks.
So, Richa, everyone's heard your personal journey. I know your personal journey extremely well, right? Now, when you now are a mentor to a lot of founders and entrepreneurs, what is it that you always look for when you are talking to a founder? Your gut is telling you this founder it's going to work for this founder, and there are other founders that you quite know that they're missing that one thing that would make an investor want to invest with them.
Largely in my experience of having pitched many times and also met a lot of founders, I feel I think the ability to articulate the problem sometimes is usually a little it's missing, right? Why are we doing this? Sometimes you might also just want to say, hey, it's a huge market, everybody's doing it, I am also taking a punt at it, kind of a thing, right? So sometimes I think that just the ability, the clarity of thought of why am I building this company is not there. And maybe some people, sometimes you just get into it accidentally and you don't think so much about it. But I think that is one thing. The second thing is, with respect to investments, I think the thought of why do we need money and what will this money be deployed for, and how will this create a difference or a differentiation in my business. I think that is, most of the time people ask for money for the most basic things. Oh, I need to hire, oh, I need to do marketing spends, etc. But there is no larger goal of how are you deploying this resource to. I think that needs to be articulated well also. And that is where an investment will feel, okay, my rupees are going to work very, very hard in taking this company from X to 10X or wherever. And that's the thing for them too, right?
So follow-on question is that, again, you know, you've raised 47 million in your previous startup. What are lessons learned from that? That I don't think Sangeeta touched on that in the previous, I mean, I do know the answer, but just the answer for the audience.
I mean, look, so it's the same thing, right? Money is a resource. Money is powerful. Money is leverage, provided you know how to use it. And most of the time, you know, people do it because they feel that's a part of doing business. And I don't think that is there. Like, it's as simple as that. If you didn't have HR function in your organization, you would double up, or you'll get a, you know, your manager or whoever is the functional manager, say you double up as the HR function to take care of some of the things that HR does. So you have to very clearly understand why are you raising money, because with raising money you're also giving, you know, ownership of the company, and you're adding people on your board who would literally, you know, you would have to be answerable to. It's a lot of responsibility, and with that responsibility, you know, if you undertake that kind of a responsibility, you need to have a very clear thought process of execution, a very, very well thought through long-term plan of saying this money will take my company to this place. And mostly, even when, you know, when I raised also, it was like, hey, the company is not making money, so we need to have money. So it was more like this rather than using the money to make a difference in the way we were building the company.
And it probably was a different phase in the whole venture community, right? B2C was something that people were willing to invest and take a bet to create that disruptive behavior. So thanks for that. Dinesh, you spent some time yesterday at Maker Village, and you had some observations about the startups you saw, not from a technology perspective, more from a founder perspective. What is the feedback that you would give the audience?
Sure. So, yeah, I mean, like I said, it was a very encouraging and productive day, so to speak. The kind of products that people are trying to build here as part of Maker Village, the kind of facilities they have access to, and I mean, the support that government is providing and encouraging, I mean, it's just amazing. I think directionally it's going very well. So 5 years from now, we will probably have a lot of success stories emerging from these places. But what I felt overall was, I mean, Rajesh was also there, I mean, he can share his own views. What I felt was that people seem to be a lot more, the founders, focused on the technical aspects of what they're doing, right? So how the product is going to look like, what are the features, what do I need to do, what material do I need to shape and use, and so on and so forth. So the team seems to be excessively focused on the technological and technical aspects of building the product, which I'm not saying is bad, it's necessary, it's essential. But what we found lacking was, in general, that they don't have enough of commercial and market sense of what they are building for, right? So have you done enough research? Do you know enough about competition? Do you have a nuanced view of why you will win? You know, how you will be able to scale, which markets you need to go after, what is the pricing power you can command, what's the leverage you will have, how important or deep is the problem you're solving. So, I mean, those aspects were generally lacking, which are very, very important once you've got beyond the prototype stage, once you have a product which is sort of ready to hit the market. I think you need a very, very good, solid understanding of all that as a team. If you don't have it, maybe you need to hire somebody. But as a company, as a team, you need to have a solid understanding of all that to avoid taking missteps and prolonging your journey and risking your success, right? And we also found that the financial understanding was lacking. So when we quizzed them about, okay, are you raising money? How much money are you raising? Where are you going to use that money for? how long, what is the runway this money will give you, what milestones can you achieve. I mean, there was incoherent, tentative, made up on the fly type of answers, right? There was no rock solid plan and thought behind it, which if I were in their shoes, I would have. Otherwise, I would say, sorry, I have not thought through that. Maybe we'll have a follow-on meeting, provided you like my product and you like the market that I'm going after. Yeah. So they haven't thought through that, which I think is again important, especially if you're at a stage where you do need to raise external funding and you do need to engage with investors of any kind, not just us. Because they are going to ask you those questions and they are going to, as Rajesh said, look for passion and nuanced understanding of your market and what financials you can really build as a business in the next 3, 4, 5 years.
Thank you. Yeah, sure.
Just adding to what Dinesh said, just one point is I also found that, you guys, some of the companies that we met have, products that can be world beaters, but the thought process is how do I move from point A to point B? That's about it. They're like, somebody saying I'll do 75 crores of revenue in 3 years or 4 years. Whereas the potential of that company to do revenues could be probably, $300, $400 million globally. So all I'm trying to say in short is one, be aggressive, think global, and don't think linear, think non-linear. In the sense you can even think about mergers and acquisitions. You can acquire companies abroad. When you ask for money, if you have proved your, model here, you can do things like that. And Indian companies now need to start doing that. We need to become as aggressive as the companies that come from the US and from Europe to do that. I think it's time for us to think that way. That's the only other point that I wanted to add from.
Satish, you were part of the jury today. You saw 12 startups, right? What would be the 3 things that, your observations about the 12 startups you saw and inputs and advice to them? Because I think at least half a dozen of them are looking to raise funds, right? So what would you give as feedback to the group?
Okay. I think some of the points have already been touched upon. One of the main things as an entrepreneur, especially at an early stage, is you really have to practice your pitch. When I say practice your pitch, you need to have a 20-second pitch, you need to have a 2-minute pitch, you need to have a 5-minute pitch. And where within depending on what is the situation, you're able to explain the whole thing in that shortened duration. And I think that's an area where a lot of these companies can spend time. And this is not rocket science, it's only practice. Just practice in front of friends, in front of colleagues, whatever it is, where you get a stranger and explain to them, this is what I'm doing, and see if they can understand. Because typically, VCs, are usually people, who have a breadth of knowledge. They don't go deep inside any specific thing unless there is a sectorial VC, right? So it's very hard for somebody to understand, if you don't communicate this well. And look at the history. People who communicate well are able to raise the maximum amount of money. And this is not a coincidence. It's just that they're able to explain their story better. They are very, very clear in what they're doing in whatever time that you have. So break down your pitches and just practice that and try to be as complete in that time duration. Second is, not every business is a VC business, VC fundable business, right? That doesn't mean, you can't run a business. When I first went raising for capital, in the early 2000s, pitched to Benchmark, and the first thing one of the partners said was, look, I am selling jet fuel. If you are building a motorcycle, that's fine, but don't come and talk to me. So the whole perspective is that for a VC economics to work, the market has to be really large. And a lot of times what we see is people try to somehow either go bottoms up or top down and show $1 billion plus market, just to show that the market is large. Most investors see through it. So don't do it artificially. You have to have some sense that if you are insanely successful, if your product works, then the market is really, really large. That's all you have to communicate. Whether it's 2 billion, 5 billion, it really doesn't matter. So if your market size that you're addressing in the best possible outcome for you is not big enough, then it's not a VC fundable business. So typically that's the biggest gate for any investor, any VC to come in and say, okay, does it make sense for me to invest or not? Because you've got to remember, if the VC is looking at getting 10x out of your investment. So somebody who gets a 2.5x, 3x, 4x, even though it returns, from financially, it appears powerful, but for the entire fund economics to work, given the failure rates of the startups and all that, it doesn't really, a 2x or 3x doesn't sound very exciting. So that is the second point. The third point is, again, early stage, you are primarily selling yourself. Why is it that you are going to be successful compared to somebody else who has the same idea? And today we know ideas are dime a dozen, right? Nobody can say, I'm the only guy who has this idea. With the amount of information exchange that takes place, ideas almost pretty much, every company, every solution you take off, 50 companies that are working on it, and maybe 50 others whom you don't know. So why are you the right set of guys or right team or right individual to be able to build this company? So focus on these 3 points where in your 20-second, 5-minute, 2-minute pitch, these 3 come out sufficiently well.
Thank you, Satish. Yeah, sure.
So great points that you covered. Let me just add a couple of things from just my experience of today, and that's not very, I would say, uniquely different from what I've been seeing in other pitch sessions and so on and so forth. There's some common threads. I've been an angel investor for a while on different platforms. I've also invested outside India in Israel and US and so on and so forth as an angel. 2-3 things I would tell you to focus on, right, and to be careful of. So passion is extremely, extremely important. Don't do entrepreneurship because it's fashion, okay, because your neighbor is doing it, right? So don't do because it's a good social conversation that I have a startup or I'm a founder and CEO of a startup, right? Second, you should spend enough time, become a Japanese if you want to start a startup, right? Spend enough time researching what you need to do, okay? Don't jump on the idea because you dreamt of something. Okay, sometimes those things work out, but 9 out of 10 times they don't, okay? So spend enough time. It doesn't matter whether it takes 6 months, 12 months, 18 months, but if you're going to build something for long term, right? If you're not in the valuation game, which you should not be, then you have to spend 10, 15 years trying to build a business. It's worth spending 12, 18 months figuring out what your space is, right? What the market is. Do field visits, do surveys, meet people, be sure, and then find the right team, right co-founders, complementary co-founders to start the business, okay? If we start doing some of these things going forward, we always talk about high failure rate. I'm telling you that's a misnomer. Failure rates will come down. Because if you see around the early stage companies, which are pre-A series, seed stage, angel stage companies, failure rates are high because of these things, right? They are not being filtered properly. Everybody is setting up a company, everybody is setting up something, and then 12 months later they say, oh, it's not working, or they find some money, find some runway, keep going for another 12 months. They just basically a lot of them are relying on luck for things to work out because they haven't really spent enough time researching and setting it up. So I'm telling you the failure rates will come down if we have greater quality of feed coming into the ecosystem.
Thanks, Dinesh. I want to open it out to the audience. This session is for all of you. How many of you all are looking to raise money? Excellent. So I want you all to ask the tough questions, right? Because this is a learning session. This is more of an introductory session, so for you to get a feel. We also have one more person, but I realize that one of us way off the stage. We have Ranjit. Ranjit, if you can please stand up from CleverTap. Ranjit has had been an entrepreneur 3 times around and now is with CleverTap. I'll just bring him in to answer, respond to some of the questions that you may have. His experience is like Richa's, which is thank you Ranjit, he comes from a founder background. He's been there 3 times now. CleverTap, I'll let him tell you about what CleverTap does, because I think it's very essential for you to realize how a Bangalore-based company today is now globally all over the world. Bombay-based, sorry. All roads lead to Bangalore, right? So, yeah. Bombay-based company is global, and what was interesting is that this morning in the car he was telling us how CleverTap is doing 10 billion events that it monitors compared to Google's search of about 4 billion. So Ranjit, thank you for finding the time to come here. So I'll let him talk to us about CleverTap, and then I'll open the floor to the audience to ask questions.
So I handle technology at CleverTap. So as Latika mentioned, some of the interesting challenges for the engineers is what we are proposing. One, which is like 10 billion events a day, as in like, imagine Google handles 4 billion searches a day, and whereas we are doing something close to 10 billion events a day. We have written our own event store, which is like, if you can compare it with a database, we have written our own database. It scales to 10 billion a day, storing and providing that kind of real-time analytics to the users. So we are helping marketers to retain their customers, as in like analyze, retain, run the campaigns, and then ensure that you can yield more value out of those customers. So entire food tech in India is using CleverTap, like Zomato, Swiggy, everyone. So anyone you name. Gojek is using us for all across their campaigns and custom journeys. Reliance Jio is using us. So this is comprising to a large scale. So some of the problems what we are solving is like, so we've just recently raised money. So with money, so when we were an initial startup, your mentality is different, team size is different, the way you are organizing team, the way you are delivering projects or products are entirely different, and the way, when you start getting into the growth phase, when you have large team sizes, then the problem changes, processes bring in. Then you have, sometimes you start feeling whether, oh, when I was like a 10-member team or a 15-member team, then the deliveries were different. And when I'm suddenly a 150-member team or a 220-member team, so most of you have seen that kind of journey. So the challenges are different. When you're looking at growth, when you're looking, so then how do you build a business which will stay there even if you are no longer there? So these are some of the challenges when they come with the growth. So that's what currently we are looking at.
Do we have mics in the audience? Okay. So if you could introduce yourself, your startup, how much money you're looking for? Yeah. You're passing the...
Hi, my name is Thompson, the co-founder of Rapidor. We are today serving SMEs, and we are growing, making sure unit economic positive is the key. But we don't see many VCs who are very keen on this, saying, okay, we would like to see some numbers that are like, unit economic positive is something that is not said so much. Isn't it a point of interest to the VCs about being profitable at least?
Well, it depends on what stage you are in. You know, typically, again, the VC model is grow like crazy, you know, do a land grab with an eye on profitability in the future, right? So what has happened is, you know, obviously the Ubers and the WeWorks, you know, have tilted the story, you know, differently. But if you are in an early stage, you don't want to focus on profitability at the expense of growth. That's primarily why you see early stage investors asking you how quickly can you grow and what will this capital, you know, do to you. Like what Richa was mentioning earlier is about, you know, additional money comes in and there is an opportunity for you to really grow the business if you keep your eyes off the profitability. But you should have an idea of your unit economics. You may not be profitable today. The idea is that you will be profitable. There's nothing inherent in the business model or the revenue model where you will continue to lose money. You know, but nobody wants you to say, you know, nobody will give you extra marks saying just because you are profitable today.
Most of these startups that we see who have raised big money are today pivoting or trying to bring in some sort of revenue model, but miserably failing. That's the larger portion that we are seeing. For example, ClearTax is trying to come up with an coursework or somewhere they can actually earn money. And still, isn't it clear to the VCs on the at an early stage that something like this is bound to happen considering the market? Or?
Well, I mean, there are two ways you can look at it, right? One, obviously, you have some bad examples where if you don't have control over costs when I say cost of acquisition, typically, and if you are a consumer-facing startup, most of the time you will see this in consumer-facing startups where you will spend enough money, to acquire the consumer. For example, I just read somewhere last week that Dunzo, for every single rupee of revenue, is losing 273 rupees. Now, that's a huge problem. I'm not an investor in Dunzo, so it doesn't bother me. But
Mr. Dembla here is laughing. He's invested in Dunzo.
I know, I'll get to him. But what I'm saying is, consumer-focused companies, there is a balance that you need to do, and I don't know what the right balance is. And from our perspective, the way we see things as an investor, we are looking at, will additional capital help you grow, get market share, without focus on profitability right now, which basically means that you're doing a land grab. But founders, typically have at the back of their mind if this is going to work or not. I don't know if any of you have read the S1 from Uber. When they went IPO, they said, we don't see any way this company is going to be profitable.
Yeah.
I mean, that's like crazy. So there are anomalies like that. I would like to believe that that's an anomaly, and hope Dunzo, it doesn't become one of that. But the idea is that you want to focus on growth in an early stage, and there's no two ways about it. Because you are going towards, in most segments, you are going towards a winner-take-all model. So in a winner-take-all model, any delay in customer acquisition can hurt the company badly. So, I mean, I can give you real numbers, right? Today, if a Silicon Valley VC, backs a number 2 in a category, he basically gets his money back. And this is billions of dollars worth of companies, right? I'm not talking about small categories. But if you back the winner, so you're getting 100x on your money. So that's basically that math that drives all this. Some of that seems insane and is insane, but hopefully, there will be some sort of a balance.
So I'm looking to raise $2 for every single SME who I'm onboarding on my platform. $2 for every single SME who I'm onboarding on my platform. So,
Every single SME or user?
every single SME.
Cost of acquisition he's talking about.
Yeah.
But anyway, I was just going to add slightly more perspective to what Satish shared. See, unit economics being positive or not is in isolation, you can't look at and comment on the quality of the business. Okay? Whether it's a factor important in the consideration set, the answer is yes. But you have to look at the overall context of what the nature of business is, what the moat is, how competitive the business is, what the market size is. Is it a business which requires network effect and a winner-take-all market? So, I mean, there are so many things you have to think about. Of which unit economics, whether it's positive today and when it can become positive, at what point it will turn positive is one factor.
Building for the scale or building for, like, say, if you're building something like B2B, so what are the distribution mechanism you're thinking from the day one can also help you determining like how you grow, what you will achieve. So like couple of startups who were presenting earlier, they were talking about partnership model as one of the distribution, like distribution as a moat, you can say. So some challenges like you can grow to a level, but after that growth, you will need to start looking at what are the GTM strategies for the other market, what he was explaining about. Then what are the different distribution channels which you are looking at for whereby you don't have to keep on adding more and more salespeople to ensure that your sales is happening. So there are different distribution channels, what go to GTM you are looking at, and so that's what you will have to think through.
Let me throw it from the other side, right? So this is what we have told you what you should do, but I'll tell you from the investor side. Every investor also has a life cycle. There is a time when investor has checks to write, and there is a time the investor has to return the money to their LPs. So if you go and ask a fund to give you money when they are almost done with the fund, most probably their feedback is not what you should be listening to, because they are not going to be writing a check, period, however good your your businesses. So I would say I've been on that side. I would only take yes as a good signal from an investor. I will not take no as any signal at all, right? It means nothing to me. I will just move on to the next investor, right? So you also have to time it. You have to look at different investors. Sometimes you may complete a portfolio for an investor. So you alone are, they're not investing in you by yourself, but they are looking at their portfolio strategy. A lot of factors which also go into play. So please don't take anything as very prescriptive in terms of saying, I gotta solve this, only then I'll get money. Never that way, right? So many companies have talked to 50, 60 investors before somebody said yes, and they went on to become something big. So just take yes is an answer, no is just wipe it and move on. Yeah.
Maybe. No, I am not answering for Dunzo. I'll let Google do all the talking. Okay. He's not taking the bait. No, I want to. I invested in Dunzo when. No, I didn't write. That's nasty. But I invested in Dunzo when it was just starting. Right then, when there was no technology, it was on WhatsApp, and it didn't even have 500 users. Yeah, so basically.
I was an early investor.
Exactly, but I want to answer Thompson. Thompson, I liked your model. Okay, I want to make your day a little better. I am seriously considering your model, so don't worry, we will talk separately. And this is also a space which is very close to my heart. Okay, the MSME segment is something that I've done all my life. Okay, so there are much easier and inexpensive ways to get the market. So we'll talk about it separately.
So I think one piece of advice, again, being on both sides, I've raised money, and I keep saying, when I've raised money, I didn't make money, but when I bootstrapped, I made money, right? And so if you ask me as an investor, as both an investor, angel investor, and a founder, it depends on what you see the opportunity is and how aggressively you want to go. So raising the unit economics, again, depends on the kind of investor you're going after. And to Bala's point, where is that investor's appetite in terms of where vis-a-vis the fund is. What I can definitely say is that the reality of raising money is you just don't know. I think way back in 2003-04 when I raised 4 million, I must have at least pitched to 20 people, and that time there was nothing called VCs. You just went out there, you just spoke, you kept going and talking about what you were trying to do. Today, there is more, I would say, there are 300 plus VCs in India. So there are different kinds of investors looking for different kinds of deals. Obviously, second-time founders who have given exits, they get preferences. Or if there is a team, single most, I would say, the one thing, and I think I'll leave it to the panel to agree, is they look at the founder and the founder's team and the ability, just the technology is not going to make that firm, that company grow. It is going to be the team that's going to make it grow. So I'm just going to, maybe ask Bala on what your thoughts are. You're seeing a lot of people at TechSparks through the Microsoft Accelerator. You saw a lot of founders. We've had some great success with some of them, Lived Out AI, etc., being bought out. So what are your thoughts about the team? Because I think it's important for founders over here to recognize what is it that's going to give the investor that aha moment, right? And kind of break through that.
I was just talking to Thompson during lunch, and the same thing is that we saw 13 pitches, and I wish they focused on only 2 things. And that is about themselves, why they care about this problem, and the problem itself. But what we saw was it was 8 minutes of pitch. 8 minutes is 300% more than you actually will get in real life, right? So like what Satish was saying, literally nobody has any attention span beyond about a minute, right? So minute or 2 if you still engage them. You guys had 8 minutes, and what I saw was I was amazed by the founders. I'm amazed by all the 13 founders. Unbelievable, unbelievable. I was underwhelmed by the fact that they never stood up and spoke about themselves, right? So none of you actually, we had to ask question. Tell me about yourself. Why are you caring about this problem? And then you kind of see how their real passion is coming out. But you are holding yourself back, and you're holding yourself back and actually projecting things that you should not be projecting. Like, you know, in year 3, I'm going to do this. Who knows, man? Nobody even knows. Even Narendra Modi doesn't know. So why do you even go down to a path of a place where you can't defend, right? I just want you guys to be proud about what you are doing. Why do you care about it? And help us understand the problem you are trying to solve. Because everything else is a degree of freedom that we can fix. Like, you know, Rajesh just now said, don't worry, I will help you with GTM. There are people who will help you with that. So GTM is fixable, money is fixable, and your, you know, even to how big the market is also fixable. But there are 2 things I can't fix: you and your passion about the problem that you are trying to solve. And hence, most investors, 80% of the signal they get is around that. You are investable if I know how strong you are, I mean, your credibility and about the problem that you are trying to solve and how deeply you know about that problem. And I think it was there in every pitch, but it's kind of a diamond in the rough, I would say. And next time, feel proud about what you guys are, and then just bring that up, and don't worry about the rest of it. Actually, I would junk the rest of the slides and, you know, keep it for another day. And another thing I also told someone is that when you talk about yourself and when you talk about why you care about the problem, you are at your best because you shine. You don't have to prepare for it. You do this every day. It's your sweat and blood, so it comes through naturally. So that's even better for us. That's a fantastic. It will be a very good, what you call, signal. So which is one of the reasons why we see at Techstars, we see about 40,000 pitches a year. So one of the things, and they write long application form, but one mandatory field in that form is a 2-minute video of the founder or the founding team, because we want to see them. We want to see them, the inflection in their voice, how deep they feel about that problem cannot be read through text. So that video is where we actually give the most weightage to. So I'm giving away some of the trade secret, but it's not a trade secret. The reason is this actually is a great signal for investors. You guys should really be proud of yourself. Great job, guys. Sorry?
Demo screens or some sort of a screenshot, and when you start explaining those things, what Bala was explaining, the passion with which you can explain your own solution, that's what is going to kick in. Other like rest of the things, like earlier I was talking about GTM, those are fixable things, true. But passion, your team, not the educational qualification, to be very honest, because something which is like, yeah, some VCs do look at the degrees where you have graduated from, but most of the VCs will not give much weightage to that. But the kind of team you are having, the passion you are having, show us your scars maybe. That can also work out.
I love that statement. Show us your scars. I think that's really genuine.
Any other questions? Yeah, go ahead.
Hi, and my name is Justin. I'm founder of Ayurvedi. I started this idea in 2015, and I launched my website in 2016. Still, I didn't get any funding. And I focus in Ayurvedic medicines and Ayurvedic organic cloth and organic vitals. Now I display our fabrics into Spain, and now I'm looking for some investors. And also we are in a plan to add some extra fields like holistic health and Ayurvedic fitness and online doctor appointments. So for that I need to market our website and all. For that I need to, I'm looking for the funding.
So after this session, you should try and figure out who's willing to write you a check.
I'm Salil. I run a fintech startup. We have our customers in US, and we bootstrapped and managed to get enough customers to go for a Series A funding. So I wanted advice on whether I should look at finding investors in India, or what do you suggest?
I think it's way little information to be able to comment.
Okay.
You know.
So we are a payment processing company. We processed close to 2 billion in transaction.
No, what I meant was, you know, it's probably an offline discussion.
Okay.
Because, you know, there are plus and minuses of both, you know. So my entrepreneurship journey, I raised about $120 million, not a single rupee from India.
Okay.
You know, everything I raised in the US, primarily because we were doing semiconductors, which nobody was willing to invest here. So fintech is a thriving market in India. And in fact, India fintech systems are 5 years ahead of the US. Trust me.
Okay.
So, you know, you have to seriously, you know, think about getting money in India. But this is a very high level answer. You know, maybe there is something specific, you know, to your company, to what you're doing. But we can take that offline.
Okay. So
I think at a broader level, in the past, a lot of founders went to the Valley to raise money. I think today, even if you go to the Valley, most likely they're going to tell you, speak to our counterparts who are in India. So whether it's Sequoia, Axel, Bloom, Nexus, everyone is Arteman, they're all in India. So you know, to Satish's point, you should probably look at the Indian market unless there's something very, very unique that you feel that the Valley is going to, you know, want to fund you.
But even in that case, he needs to move to US.
Yes, you'll have to move to the
Yeah.
US, be there in the US. Yes.
So correct. I mean, it's a detailed conversation. It's difficult to answer in 30 seconds.
So we'll have some session for mentoring, you know, post this session. You can go and speak to them then and tell them more.
Hi, my name is Aronin. I'm one of the co-founder and the CEO of Shastra Robotics. We are a 5-year-old company. So I just wanted to ask you, all the investors, a simple question. 6 months back, when I was part of DNA Accelerator program, we were an early stage company with an accumulated revenue of 300 crore, and we are building a platform, which is a test automation platform, which is going to help small and medium and large organization to help with go-to-market time reduction. It's a platform which replicates human manual testing automation device. So in that time frame, in an early revenue stage company, the amount of investment we understood to raise to take the company to the next level is 3 million, approximately 21 crores in India. And I explained why we need this money and what we are going to do that, and out of which we can probably reach a revenue from 3 crores to around 38 crores within a time frame of 24 months, and with a firm forecast of nearly 115 crores worth of revenue. And I used the same pitch deck. I happened to pitch 16 VCs in India, and 3 out of 16 said, Aronin, you have to look a little more about the spending, you have to raise a little more. And the rest of all the VCs said, why you need this much amount of money? And the second week, I used the same pitch deck, I used the same story. I pitched Pittsburgh, Boston, Silicon Valley. And that week, I happened to won the TIE 50 award from Silicon Valley. Just after listening our story and after seeing the basic presentation of our product, every investor just told me, at least you ask just 5 million or above. And if you want us to invest, you have to set up an entity here. Then I cross-check why it is happening, but still I'm confused. Here, last 3 weeks, I happened to meet around 8 investors. Out of 2 only convinced that we need to raise more amount to take it forward. And the opportunity side, 8 days back, I happened to understand one of our first client closed a deal around 20 million using 13 of our robot. And they spent around 2 crores on us. And they raised more than 120 crores of revenue from that 13 robot, including their infrastructure and 13 employees. And they are going to close another 3 deals from US, again same ticket size, and 3 or 5 other companies are willing to take. We happen to sign an MOU with Lockheed as well. And the question, why both Silicon Valley or global investors as well as Indian VCs need, the founders need to build a billion-dollar business. And why is the difference between when it comes to the investment at 2 million a pre-series or series A ticket size is feeling like a bigger amount for the Indian VCs and a smaller amount for the global VCs?
So I'll answer the last part. I think there's a very straightforward answer. A McDonald's burger, how much it costs in Cochin and how much it costs in New York. That's why 2 million funding in India, if you raise, is equivalent to a $8 or $9 million funding round in the US, right? But whether you have the cost base to deserve that level of funding, it depends on what is your base in the US in terms of either development team or center or marketing people or whatever, right? So it depends on how you are set up as a company, but VC's lengths differ because of which country they operate from. And accordingly, their fund sizes are different, their ticket sizes are different, and so on and so forth.
Any other questions? We'll probably close this with the last question because we do want to have at least one, mentoring session with all the mentors. We're going to have different tables where you all can go in and speak in smaller groups. So one last question before we get on with
Sure.
that.
Yep. So far, the session has been very insightful. Thank you, Latika, for making this happen over the last 2 days. My question is very simple. Me and my co-founder, we have a continual debate on, whether we need to be cocky. I'm sorry if I'm using the right word. Cocky versus aggressive during a pitch is a continual debate that me and my co-founder has. So he is always of the opinion that we need to be cocky, we need to be aggressive. We need to just hit them in the jaw. So it's a very subjective question. How do you see this as an investor sitting on the other side of the table? Personally, you, Mr. Dembala, Mr. Goel, do you actually enjoy or do you actually appreciate that? Just being open about it.
Not my day-to-day.
Maybe my co-founder is reading those articles.
Founder drives Porsche, there is one terminology, you can search for it. Like founder comes to the meeting and he behaves or acts in such a way that he doesn't need money. So he drives Porsche on his own. So something like that, when you're too cocky that I don't need your money back. Something like that, if you're, so think about it that
Not cocky to that extent, but
maybe just a BMW.
Says, I want your money. I want your money, but I want to be cocky.
If you are chasing a large market before you pitch to an investor, spend 4 weeks in Delhi. Okay? And drink enough beer with the local guys, and then you will know how to pitch.
See, I mean, Bala mentioned something earlier, right? Try to be natural. Even if you fake cockiness, people will spot it. So
wait, I'm going to put Richa on the thing. She's gone through multiple rounds. So Richa, what was your attitude? I mean, I think you'll be the best one amongst all of us right now, and Satish, because you've both raised very large amounts of money, and you raised it here, so it's a difference from there. So what is your advice?
So I was just myself, but it's also stage. You have to. It's like it's really like a dating game. Like people also like the chase. Investors like the chase. They like the FOMO of it. So sometimes you want to be saying, "Oh, I'm not looking for money," and the investors will get very excited when you say you're not looking for money. So you have to play to their psychology a little bit. You have to say somebody else is interested. You make them work, on their deal, and you kind of create that sort of excitement without being cocky. So you can try and do things to get their interest, like do the drama or the theater, you don't have to inherently change your, general personality style, because it's very difficult to keep up with, and the investor can understand that you're faking it. But play it to them. They like to believe they have got a good deal, right? Everybody wants, it's a buyer-seller sort of a market. So you have to make them believe they've got a good deal, even if you feel that they are paying an expensive price or a higher price for that same thing. So they should feel that they have been the chosen one. It's a coveted one. They're the first to spot the opportunity. They have come in early or they have come in cheap, whatever, that kind of a thing is how I would say. Cocky is a little tough because fall from grace is then very, when if you fall, now some of the celebrated entrepreneurs, especially in US, recently WeWork, etc., right? All that swagger, all that flamboyance, when you fall from grace, it becomes very hard and you disappear very quickly. But humility and grace, I think, can take you a longer way, and it lets you absorb failures much better. Your customers, your consumers will be far more forgiving. Your stakeholders will be far more forgiving if you are authentic, you are humble, and you are, you're a real person. That's what.
So just since you asked me, let me just answer your question. See, I would personally see that if the founder and co-founder are discussing this, I would rather you be discussing how to start making revenues. That's really what I would look at, If you're focusing on how to get revenues, the rest of the things will start falling in place, or at least start seeing how you can start acquiring customers, as quickly as possible. Don't bother about, something that's not even important to your business.
I just use 2 words to sum it up. I look for 2 qualities: confidence, coachable. You need to present these 2 in terms of how you come out. You need to definitely be confident, but you should also appear coachable. Almost every investor look for coachability of the entrepreneur.
So Bala is using 2 different C's.
Yeah. No, the coachable actually is, so Richa and I, she supports me in Sauna Connect, where we work with a lot of female founders. And now that I'm traveling and I'm, really, I'm very rarely in Bangalore, I request her to actually vet many of the founders. And literally in 3 words, like she will send me, not coachable. And immediately we've actually, she summed it all up. So I think that word is, are you open to feedback? It doesn't mean that you don't know and you're going to roll over and accept everything that has been told to you. But the coachable part is, I think, Bala, thank you for that. It's a very important. There are founders that we just like, we fall asleep because we've just said something to them and they keep on and on trying to get you to convince. It's not that none of us here, at least at this table, I can guarantee you, are there to make you feel small, right? There may be, I'm not saying that's going to be a universal, I would say, meetings that you would have with investors, analysts, etc., who will try to make it. But I think in this set, we're not here to take your confidence away from you. We're not trying to make you feel small. At the same time, we do want to understand, A, whether you believe in your product. Most importantly, do you believe in the business? B, is there a market fit that you see? Not something, I remember Kunal Shah of Freecharge, he spoke once and he says, I don't understand entrepreneurs who come back and say, I had this problem and that's why I started the business. He says, your problem is your problem. Keep it to yourself. If that problem is a problem of 1 million people or 10 million people, especially in a B2C business, then it's a problem that you should go and try and solve. Otherwise, keep the problem to yourself and don't do anything about it. So thank you everyone. I thank the panel here. We're going to just group in maybe groups of about 10. The mentors will go from one group to the other, so you get some time with each one of the mentors. It's an open format, question and answers. So thank you everyone.